Disclaimer. Trading financial instruments carries risk. This material does not contain investment advice, nor should it be viewed as a personal recommendation, or an offer of, or solicitation to trade in financial instruments. Past performance is not a guide to future results.
Hello everyone and welcome to a new review of the week, a new summary to give you a quick update of the situation, the global situation of the market. We're going to take a look on currencies, equity, but mainly let's go to the point. I want to share with you what is the main topics that we have been following the last few days on the market, and it has been a really interesting week because we start the week on Monday with the impact of the European elections. It was a high shock, particularly for France, because the main intention of vote is going to the what is a far-right nationalist party, which is Le Pen. And please keep in mind, years ago, now things seem to be more soft. But years ago, Marine Le Pen suggests that if by any chance they gain the government, that one of the measures they could take, it was abandon the euro as a currency and get back to the national currency of France, which is the franc, and that would be obviously a massive shock on European currency. If not, the death shot, the end of the currency as it is. So it's a very interesting topic that we should follow in the coming days, because Macron, the strategy of Macron, and this is what it was impacting the market. The strategy of Macron, it was okay, fine. 30% of the votes or intention of the votes in European elections is going to the National Party. Obviously, it means a failure for the Macron as a party, as a leader of the country, and for his party, and therefore he was just calling for new elections in France, and that's the main risk if the new elections actually can cause earthquake on European area, and it's what the market has been discounting since then. We got in one side, we got, for example, the let me show you the bond, the German French bond. This is the German one, so let's put the French bond, and you will see the volatility caused there. Also in the CAC 40, in the equity index from France, has been moving aggressively. The volatility in euro has been increasing. In general, all markets, particularly today, Friday, European markets are closing with massive drops. We're gonna take a look also on DAX 40, the biggest one in Europe. But as you can see here, this is the move, 7.14% in a week. The move of the French bond. Even when it's the French flag there now, it's updated. Okay, so high volatility on the bonds, which is reflecting the risk as a country. We can see that the risk of the country is increasing. One of the topics I shared with you on social networks today, it was, let me see if we can find here. It was the spread between the French bond and the Portuguese bond, published by, I'm not sure if it was Reuters or Bloomberg. I just published it here. For some reason, it's updating super slow, the charts today here. But I mean, internet seems to be running so slow. But I can show you the main problems. This is UK. We need to talk about UK in a minute, because it's also expecting, I'm expecting certain volatility in UK, considering same topic, elections. Because in the case of UK, we got a new party, which is Reform UK, which is the old ultra-conservative nationalist party UKIP, and is rising also in the polls. In the previous elections, UKIP was not a candidate for national elections, just to not try votes from the Conservative Party. But now Nigel Farage, which is the leader of this party, has announced that he's coming back. Here's the news. Following closely the words from Donald Trump, he actually said, "I'm back. Let's make Britain great again." It's expected that probably cause a massive drop in Conservative Party in favor of the Reform UK, the National Party, and therefore, again, certain impacts, especially in the pound. That if you take a look at the pound in the right perspective, let me say with you. Sorry about this. I got a lot of tabs open. This is the long-term good view of cable. You can see since 2009, obviously we can see a downtrend, and obviously what you can observe right now is we are on the top of the downtrend, which means like eventually the pound could get weaker against the dollar quickly. And I believe the trigger for this situation, let me share the whole screen. the trigger for the situation obviously could be easily the results of the UK elections. If Reform UK is actually kicking out from the opposition, the Conservative Party. Why? If you take a look on cable, it's not reflecting any risk. It's actually strong against the dollar, even when the dollar is resisting well. We got the index dollar in 105.50, which is certain strength for the dollar. But if we take a look on the cable is not reacting against the dollar. I mean, it's still super high. You see, even with the drop of the last two days, the last 48 hours, it's rising strongly against the dollar. Even when the results in UK are not so good, because we have been updating the results, the macroeconomic result, the growth rate on United Kingdom, for example, the industrial output, it's weaker and lower than expected, which in theory should move the things in a more weak pound, because the Bank of England in theory will cut the interest rates to stimulate the economy, which is what they expected, and still the pound is strong against the dollar, which in my opinion it's discounting probably huge impact in or a volatility event in the case of UK elections, because it's not discounting the possibility that both parties, Conservative and Labourist, both are almost the same thing. They are in the same page in the main topics, which is foreign policies, fiscal policies, almost more or less the same with certain difference, tiny difference. But Reform UK is a different topic, completely different topic, and it could scare the market in the same way that European election has scared the whole market in Europe. You can also take a look right now of the results, and still today, the whole week, but still today, Friday, is closing the week with a massive drop on equity markets, particularly in Germany. If we take a look on CAC 40, we're gonna find also some problems there. That's why I believe we are about to see same. You see, double top and then dropping since Monday. Reversally, I believe this actually is the range that we're gonna see. That is probably projecting down and taking the price back to previous levels. There is a gap here, so 7,550 points, or even lower, 7,450 points could be probably the target, or with this massive drop that is experienced right now the European stocks. Let me set the whole screen so you can see in detail, but this is the situation right now. Okay, so pay attention to the European markets, and in contrast with the UK equity, we got the mini SP500 on the screen right now, and as you can see, is in a new top record of 5,500 points. One of the main motivations, it was two topics that I published on 2 days ago, which it was on Wednesday. On Wednesday, I was published the results mainly for inflation, which was dropping lower than expected, which means nothing, because if you take a look on the, let me check the screen. I want to show you what is the inflation rate in the United States, so you will get the proper perspective of what is going on here. But inflation was dropping, as you have seen on Wednesday, but dropping from 3.4 expectation to 3.2, I believe, which is nothing, believe me, if you take a look of the long-term inflation in the United States. Let me set the screen. Let's see, and we're gonna go immediately after to the results. So in general terms, inflation was dropping, and Jerome Powell was announced that yes, we're gonna cut the interest rate this year. Well, that's what he said in December 2023, and we were expecting 4 cuts, 25 basic points, 4 cuts on the interest rates on 2024, and so far it was zero. Therefore, if he was lying to you in December and the expectations of interest rate cut didn't came, why you believe now they're gonna came after all? And this is the inflation for the last year in United States. If you believe the inflation is dropping in United States, take a look to this chart and you will find out. Because we have seen how the inflation was rising from 2021 to 2022, dropping during the 2023, and since June 2023, the inflation has been just making zigzags and moving in the area of 3.5%. That's the reality of the United States, so don't get fooled by Jerome Powell with the interest rate cuts. Another topic is if by any chance they consider that, you know what, okay, fine, 2% is not anymore a goal. We're gonna set an inflation of 3% in long term. For the next 2-5 years, inflation gonna be moving in around 3%. Done. And regardless that, we're gonna cut the interest rate, which is more or less what the Central Bank of Europe has done. Even when the core inflation was rising in Germany and European area, still they cut the interest rates, which it's a kind of action that we could never expect from the conservative German central bankers, but still they did it because obviously there is a kind of dilemma right now. It's supporting the growth the growth of the economy in European Union, or try to contain inflation. So I believe they choose the first. As you can see, the SP 500 was reacting positively to the words of Jerome Powell. That's why we are right now ending the week in a top new maximums of new tops of 5,500 points. We also have seen a drop of the bond, but it's still nothing. I'm gonna show you now the US bond. 2 years US bond is moving for 4.75 to 5% and dropping a little bit below 4.75, but still certain levels are there. Dollar index was dropping and still is back to 105.50 as I saw you a few minutes ago. Therefore, the good news is equity is taking the words of Jerome Powell as a positive to keep growing. Dollar is discounting like is not true because it's coming back to the main levels. Let's take a look. So what we can see here is based on dollar index is back to the strong levels again. So it's moving back to these levels. This is the dollar. Okay, fine. So zero effect of Jerome Powell words. If you take a look on the bonds, it's still weak, but not so far. I mean, this was the expectations of no interest rate cuts would move into 5% the bonds. We have been moving there, but still the expectations are not so positive comparing with January, February, the first 2 or 3 months of this year, after he promised here cut interest rates during the year. It was dropping the yield on the bonds, and now the yield of the bonds has been rising accordingly with the lack of expectations of interest rate cut for United States. So this is where we are right now. And the incredible thing is, regardless this, a strong dollar and a high yields on US bonds, the equity market is responding positively. Okay, fine. Watch out, be careful, because it could be the next week in the coming sessions could be just a correction to cover the gap. The excuse could be, risk in Europe is actually pulling the markets down, but I guess so far we just break out the new 5,350, which was the kind of resistance there. We just break up those resistance, and then probably any drop gonna call for more buys on the US equity. Full screen, and I think so far, I mean, there is another events that we could share with you, like for example the submit this during this weekend in Italy of the G7, also Switzerland conference to negotiate the peace in Ukraine. It was expecting 90 countries. So far, only close allies of the United States are going to that meeting. That submit because, as China say, Russia has not been invited to the conference, and therefore there cannot be a realistic negotiations if Ukraine it's only there, but not Russia to negotiate nothing. So that's why China is not going there and is pushing with the plan for peace that they put a few months ago on the table. They still say this is the plan that we need to follow up to establish conditions for the end of this war. I believe that's all. Political risk in Europe. Words from the Federal Reserve, from Jerome Powell, which I think is a kind of magic effect on the market, but it's still not realistic. And good numbers from inflation perspective in United States, which is obviously good, but in long term we know it's not a solution because they got a systemic problem with inflation, and it's obvious. And so far, if you want to follow up in more details I just update and publish all the reports here with geopolitical news, with all explanations, and with all macro data, include, for example, I didn't mention this report, but you got a good explanation of what was the last measures taken by the Bank of Japan, which is announcing like, we're gonna take certain measures, we're gonna actually apply a tapering on the bond, on the bond market, but still they don't say when they're gonna start. So there is zero effect in terms of liquidity if you announce like you're gonna reduce the liquidity to support the yen, because the dollar yen is going explosive, it's super weak right now, yen against the dollar. So if the measures by Bank of Japan is like, okay, fine, we're gonna intervene the bond, the fixed income market, and we're gonna start to dry liquidity from the market by stopping the purchase of bonds. When? Well, in the future. I don't tell you when. There is zero effect, my guess. I mean, they cut the interest rates a few months ago, and they say they're gonna keep buying bonds, so it's no neutral effect on the liquidity, and therefore Japanese yen is in trouble because it's causing a problem in the trade balance, because obviously the importations are more expensive, and therefore inflation can be a systemic problem also in Japan, which is already a problem. It's gonna be a chronic problem if they cannot recover the strength of the yen soon. Okay, now I think that's all. So hope to see you in the next report, and take care. Bye bye.